Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. I'm Ed Lopez, and today my guest is David Semple. He's a portfolio manager at Van Eck and oversees our active emerging markets equity strategy. David, thanks for coming on the show.
Thanks, Ed. Thanks for having me. Pleased to be here.
This is great. It's a great opportunity to be able to sit down or stand up with you and have a chat and spend some time with you. We really haven't had an opportunity to get to know each other, so I'm looking forward to our conversation.
Careful what you ask for, Ed.
Maybe we start out with a little background, kind of get the motion going here a little bit. Obviously, I hear a little bit of an accent. Where are you from?
Well, Ed, we all have accents, but we're just from different places. I'm Scottish originally, but I haven't lived there for a long time. I haven't lived there for, at least 25 years. So I'm somewhere, global citizen me.
Yeah, that's good. And you've been kind of all over, it seems like. It's been a lot of time in Asia, and you've been at Van Eck since 1998. Is that right?
Yeah. I actually sub-advised for Van Eck before that when I was with an organization in Hong Kong. So the relationship is close to 25 years.
Wow, that's fantastic. So can you walk me through your background a little bit? I mean, did you start out wanting to be in portfolio manager or in finance and investments?
No, I started out in deep ignorance and complete uncertainty about what on earth I wanted to do for a living. I mean, I knew what the ultimate consequences I wanted to be, which was basically, have a comfortable lifestyle. But I had to decide at age 16 what I had to do at university. And it's different in Scotland where I went, where you basically tell the university what you want to major in, and it's really hard to change after that. So at 16, I mean, what did I know about things? I knew a lot about, pop music or whatever, records, rock, whatever, but I didn't know much about career choices. So I ended up doing law just because, there really wasn't a very wide thought process in this. It was kind of doctor, lawyer, accountant. So I then spent the next 5 years doing an undergraduate and a postgraduate qualification at Edinburgh University. Then I worked for a year, and after all that, I finally decided this wasn't for me. I mean, arguably, I should have thought about it or I should have acted on it earlier. My wife and I went around the world, spent a lot of time in Asia, stayed with a couple of good friends. One was a portfolio manager in Australia, and one was a broker in Hong Kong. And, through traveling through Asia, this is in the 80s, you could see what was happening. I mean, the region was booming. And to be frank, I kind of liked the lifestyle of the broker in Hong Kong and the fund manager in Australia. And I thought, you know what, let's see when I go back if I can get a job doing this. It gets me back out to Asia. And these were kindler, gentler days. So it was much easier to get a job with, essentially no financial background. I think I'd done one course on tax. And I was fortunate enough to have a couple of opportunities in Scotland. I worked there for 3 years. And then after that, I got an opportunity to go out to Hong Kong, which is what I planned for all along. And I was there for 5 years and then moved over to New York after that to work in the Van Eck New York office.
Wow. Okay. Do you find that some of your training as a lawyer has helped in portfolio management at all, or your critical thinking about companies or something?
Maybe tangentially. I really don't think, mostly through the ability to use really, really long words and confuse people.
So maybe we could talk a little bit about emerging markets, the current state of emerging markets today. Kind of given the COVID-19 crisis, have emerging markets as an asset class performed as you would have expected?
One thing that stands out to me is that if someone had said at the start of the year, look, there's this new virus, it's going to be a pandemic, it's going to originate in China, I think very, very few people would have said that the Chinese market would be one of the top performing, if not the top performing major stock market in the world. I think that's a surprise.
Yeah.
As well as the surprise from last year, which said, okay, the US and China are going to go at it in terms of trade, tariff, and so forth. and yet the US and China are going to be the two best performing stock markets. So there's it's kind of weird in that way. And I think what's happened here is I would concentrate on acceleration of trends and discrimination. So there's a couple of words here. Acceleration. In other words, countries that had issues going into this, right, where they had high public debt to GDP, for instance, or current account or external account challenges. These will be exacerbated by this. Look, everyone's going to have lower economic growth, emerging markets, developed markets. So if you go into it with these bad things happening, I think that's they'll be exacerbated out of this. Some of the fundamentals by industry, for instance, carbon emission being challenged, that clearly is being impacted as well. But it also accelerates what's happening in terms of e-commerce, in terms of video games, in terms of cloud spend to support all the digital infrastructure. Something which I know you know a lot about, which is the esports. That's certainly something which maybe not the physical, but I mean the propensity to video game is clearly gone up. I don't think anyone's reached the end of the internet yet, but I mean, people are spending much more time on that.
I think you're right. I think you see a lot of either weaknesses being laid bare, both in developed and emerging markets, and I guess the acceleration of certain trends. Especially on the video gaming side, we've seen that, and some of those trends perhaps accelerating in emerging markets, like you talked about. What are some risks that concern you about the impact of COVID-19 on these markets?
I think one of the biggest risks, and this goes to sort of existential question about emerging markets that I see, and particularly because I'm based here, is that the public and politicians' attitude towards China has deteriorated. I'm not here to stand up and defend China in any sense, but I think that particularly as we go into the heavy political season here in terms of the election, politicians seem to be scrambling over each other to be the biggest China bashers out there, and I certainly think it's going to be part of what has happened. But we've seen increasing nationalism anyway. And I think that's a physical manifestation of what may happen in terms of not the end of the golden era of globalization, but its impact is getting less and less. So I think that's, something that does concern me as we go into this. I mean, we've had this era where we've had multinational organizations, where we've had comparative advantage. I come from the land of Adam Smith, obviously, so I love comparative advantage. I believe in it. But these things go in cycles, and they're big cycles. And we're starting to see that being diminished the effect of it being diminished. And it's also driven partly by some of the innovations that are happening. So it's not all negative news. So innovations such as, 3D printing, industrial automation, that encourages at some level reshoring. And that's what's going to make it difficult for some of the poorer economies in emerging markets to really pull themselves up by the bootstraps and become middle income types of economies. These opportunities are just not going to be as readily available anymore. So I'm worried about this, that we move further and further into that kind of nationalistic type of sphere. You're going to get some pretty wasteful investment, some overinvestment. And that's not good for global growth. And, taking a wider point, everybody's becoming more indebted. It doesn't matter where you look. It doesn't matter if you're looking at developed markets, Western Europe, what the ECB is doing, what the Fed's doing, the fiscal spend in the US, or you're looking at places like South Africa, which just announced a new fiscal package, which on the face of it, I think it's actually less, but on the face of it looks like 10% of GDP being spent on it. Once you have those high levels of debt, it becomes incredibly difficult for the central banks to actually raise interest rates, and you get into a situation where we will get more direct government involvement in everything. Basically, you'll get state champions more. In the past, you'll get protected industries. because they're within their national confines. And that just lowers growth rates overall for the whole world. And if some emerging markets are the weaker links in this, not all of them, but some of them are, they are going to be disproportionately impacted.
Do you think that all of this changes the typical emerging market investment case? It was invest in emerging markets for the growth opportunity as populations move from poverty to middle income, as you say. Is that going to change, or is there a different case now for emerging markets, or a different way of looking at it?
I think one of the constants of emerging markets has always been change. If you just look at it simplistically in terms of the countries, when I first started, you couldn't invest in China, you couldn't invest in India, you couldn't invest in Korea, you couldn't invest in Taiwan. The countries that mattered were Malaysia and Mexico. That's how you made your money, your career, whatever. As we've moved forward, it's very much the growth outlook has changed. So, it sounds almost trite to talk about, middle class growth, and particularly Asia, but it is real and it's genuine. But what that illustrates is the growth is not coming from, necessarily from their external accounts, from exports. You look at China, it's pretty much balanced on exports and imports. It's getting close to that. But what it comes from is the increasing propensity for those economies, particularly those large-scale economies, the continental type of economies. It comes from their domestic demand, from their consumption within it. Look, for many years, we talked about how consumption was rising in China. And it was, but you also saw a lot of other things happening. Now I think it's going to come into stark contrast that really this is what drives the economy in China. And the good thing about the way that we run emerging markets strategies is that we are active. And I know, Ed, you do a lot of passive stuff, but bear with me. Active guys can look and see, well, the index tells us to buy this, and that's a historical construct. That's what was in emerging markets. So take China as a case in point, Chinese state-run banks, smokestack industries. And we've always been able to invest in the forward-looking part of that, the healthcare, the internet, tourism, all these sort of things that people want to consume now, experiences. And that's, I think, pretty interesting that the consumption is becoming more obvious and more based in terms of experiences and services. Now, this COVID, obviously, the socialized consumption, the restaurants, the tourism, those sort of things are going to be harder to come back. People will go back to work, but it'll take them a little bit longer to go back to play. But the remote consumption is something that, we've always been invested in, we found to be very interesting. So that is the e-commerce, the video games, the telemedicine, those types of things, and increasingly cashless societies. As you know, we've been involved in talking and thinking about a lot of things related to digital currencies, Bitcoin and so forth, and other cryptocurrencies. Well, China's gone ahead and launched its digital currency. They have a trial ongoing right now. It's more of a wallet, if you like, but the more that they have that money digital, the more they'll know what's going on. That's the dark side of it, I suppose. But still, at the forefront of that. And I think that's pretty interesting.
Does it influence your view on what the U.S. should do in that regard? Is it something that we should be running to hurry up and develop a digital currency? Or do you think that the Chinese will see wide adoption of their digital renminbi?
Yeah, it's habits more than anything else. I think some of the countries that you would expect to maybe have moved further down have not. So, the Japanese and the Germans love cash. But it's coming. I mean, it's only a matter of time. So the pace of it, I don't know. It's one of these situations where, you can see the trend and it's all very interesting, but sometimes there's just so much competition, it's hard to see who the winners are. I think it's pretty easy to see who the winners are in China. Generally speaking, as a rule of thumb, you either go with Tencent or Alibaba, one or the other ecosystem, and that pretty much works. But in places like Brazil, there's it's kind of like a wild west landscape. All we can say is that Brazilian banks typically have much higher margins than normal around the world. So That's why everyone is attacking those margins, those fees that they get from a variety of services, including payment.
To go back a little bit on selection of different future trends, if you will, within emerging markets, or find it. What I got out of your discussion was the need to target kind of the local consumption companies, the companies servicing those needs. Is it a generalization to say, because if you look at a lot of the passive benchmarks, the typical benchmarks, they tend to be very cap weighted and very heavily oriented towards global multinationals. So one argument might be to focus on mid cap and small cap companies in those local spheres. Is that an adequate approach?
It's an interesting question, and it's particularly relevant given the differentiated performance that we've seen over the last 3 or 4 years. And again, this has accelerated into this at the start of this year, the first few months of this year. What I mean by that is that small and mid cap within emerging markets has actually underperformed large cap in emerging markets. And I think there might be a number of reasons for this. I mean, passive certainly has something to blame for it. If all the money goes there, then it doesn't allocate the current strategies out there. The ETF strategies don't allocate equally across market capitalizations, right? So that's part of it. And then this year, what we see is very typical in emerging markets, and we've advertised this, we've talked about it, and it's happening so far in textbook fashion, which is in times of real stress in emerging markets, what happens is that people crowd into the large caps. For one reason or another, it tends to be the smaller caps that sell off more than large caps in emerging markets. But interestingly, in the work that we've done, and when you look at the operating profitability of small and mid caps as a group, it's less variable than large cap. So large cap has more cyclicality in it, has more ups and downs, and will be stressed more in terms of profitability, and yet it outperforms. So implicit in that is there's a multiple contraction which falls extra heavily on small and mid cap. And the reason why it's a little bit different in emerging markets has a lot to do with the legacy of emerging markets. Many of the countries came from quasi-statist, communist type of backgrounds. In any event, they had a lot of national champions. And those national champions tended to be in more cyclical industries, which kind of makes sense in a way, because the more that you have to invest in heavy capex without an immediate return, then maybe that is more suitable, more appropriate for that kind of government type of investment. It's a bit like investing in things, for the military or whatever. You're not going to get immediate commercial payback, but ultimately get some good things out of it, like, radar or whatever it happens to be. And what has happened is that you get those state champions in energy, materials, financials. So you've got that high degree of cyclicality in large cap land. Smaller cap tends to be much more focused on the industries that are going to drive emerging markets before. So referencing back to what I was saying, that consumption, if you want to go after that, you're going to find it in small and mid cap land. Now, there are exceptions to that, like the Tencents and Alibaba, but they're the exceptions rather than the rule. The rule is that you find these amongst those private companies that are not state champions in the highly cyclical sector. So it's particularly invidious for us to see small and mid cap have their multiples contract when they have this. They're not unaffected, but they're not as affected as these heavily cyclical industries.
How do you evaluate the valuation of companies in emerging markets or in various locales? What's your basic approach, and what are the relative valuations as you see it today to developed markets?
So we use an approach which basically we look at a range of different things to try and triangulate what appropriate valuation is for a company. And that's not done in a vacuum. Obviously, we're looking at the risks that the company has, not just for itself, but in the context within which it's run. So in other words, the country, the regulations, and so forth. And one of the contexts, obviously, is interest rates and cost of capital. What should the cost of capital be if interest rates are 15% versus 1%? And as we move into the zero interest rates or closer to it, pretty much in developed markets, and then under the cover of what's happening in developed markets, emerging markets are obviously cutting rates pretty aggressively as well. Then it raises the interesting question of what you should pay for companies in a that low, very low interest rate environment. And it also raises the question where, value has been a real struggle in emerging markets for quite some time now. And like developed markets, growth has done very well. And if you can't, in my mind, if you can't see business cycles normalizing, which doesn't look to me like it's going to happen. I mean, the ability to raise rates is pretty limited. Then it begs the question, if you can't see that, and if you have more and more intangibles as part of the value of a company, there's less for the value guys to hang their hat on. Now, we don't invest without, disregarding valuation. Of course, we regard valuation, but it's very much a function of the type of company, the business model, the environment it's in, and then also crucially the management as well. We spend a lot of time visiting with management, getting to know them, understanding them, not just their day-to-day management of the company. Are they controlling costs? Are they controlling working capital and so forth? Not just in terms of their ability to allocate capital over a cycle, but also how do they think about us as minority shareholders? Are we just along for the ride, or are we equal partners? And so that's very important. And that is a risk that you have to factor into valuations. You can't just say, look, here's the numbers. If I tell you what the numbers are going to be in the future, give me a valuation, because it's not as simple as that, because you never know. Some of these companies might do something which is pretty daft. And sometimes, actually it comes from naivety. It's not venality. It's not that they're trying to rip you off. They just don't appreciate how things can be, perceived by shareholders. And part of our role is to go and say to them, look, we really don't think we should do this, or if you're contemplating that, don't do it, because sometimes it's very short-term gains that they see, and the long-term gain, we call it the market cap conversation. So do the right thing, you'll be rewarded in terms of multiple, and we will all do well out of this.
Is that an evaluation of governance, to put it into an ESG framework?
Yes. I mean, governance is front and center for what we do. And of necessity, it's a bit more holistic than the sort of box checking, list ticking that you sometimes get for ESG. Of course, we're concerned with what is the compensation of the board, but we're looking at that. We're saying, look, you have to have diversity of opinion here, and this is important for us. You can't have just everyone, thinking the same things, deciding these matters. It's nice to have other people there. I'll give you an example. There's a company who we've invested in other companies that do female-based microlending. And this other company came to us, it was IPO, and we said to them, look, so let's talk about the board. And it's female-based group lending, right? There wasn't a single female on the board.
Huh.
That was a short conversation. So that was an easy one. But in many cases, you see this this journey that companies do. And it might be a generational thing as well, where you start from very entrepreneurial, maybe cut a few corners here or there, and or take advantage of a system or something like that, and that's the start of it. But then it morphs into something which is much more acceptable to public markets, and quite often that might be a second generation coming in. You've been doing it so long now that we're in second generations of some of these families. And quite often it's the same family, and that's something which people don't necessarily realize, that a lot of these families have been the corporate titans for a long time. There isn't necessarily that creative destruction in that case, and that's certainly the case in places like Southeast Asia, India, for instance. So the good thing is that typically we've known a lot of these companies for a very long time. Let's say Reliance or HDFC Group in India. And, we're investors in both, and we know them. We know, in a general sense, what they're like. But it's not been the same the whole time, put it that way. Maybe for some it has. But for others, it's changed over time and become more publicly acceptable in terms of what they do. And that's partly related to the scrutiny that people like us put them under.
And talk about picking your spots and calling the need for your type of services on the active side. And by the way, I'm vehicle. I'm not necessarily passive or active. I'm vehicle agnostic. I'd love to have an active strategy in an ETF, especially if you're behind it. So we can talk about that. So China is coming into the big broad benchmarks. It's I think currently something like 40% of the big broad benchmark. Is in your view, is that an appropriate weight? Is that how do you look at how the benchmark is handling the inclusion of China and China A shares?
I think the standard benchmarks are going to get into a real bind. The issue is that China should be larger. In fact, there's an inclusion factor for China A shares right now. And once if you added all of China A shares and at the 100% weighting, the normal weighting that other countries are at, you're over 50%. Particularly if you take out Korea and Taiwan, because Korea and Taiwan arguably shouldn't be in emerging markets anyway. And it is an artificial construct, emerging markets. As I've said quite a few times before, if it wasn't an asset class, it wouldn't be an asset class. We grew up with this when there was a thematic about rapidly developing economies. But, now we're getting into some very differentiated places. I think everyone can understand that, Korea is very different from Nigeria and Taiwan's very different from Peru. They just are. Stages of development, industries they're involved with, demographics. The point about China is that if you're thinking of yourself as allocating to emerging markets, increasingly you're going to look at that and say, well, hang on a minute, half of it's China. And then you'll go into this thought process, which was particularly prevalent about this time last year, about we should separate out our China exposure. We'll have a China manager. And of course, there's all these China managers running around propagating that idea and saying it's a great idea. We're on the ground. We see things before other people. There's lots of reasons to be hesitant, let's call it, about that. But in any event, one of the key reasons is, well, what do you do with the rest? How do you invest in un-China? So you say, okay, I have $100 in emerging markets and 50 of it's in China. I'm going to give that to China manager. Who do I give the rest to? And there aren't many opportunities in that respect, the un-China part of it. And then you look at China's increasing influence on a lot of the countries in emerging markets. Obviously, they're proximate neighbors more than anything else. And you say, well, how can we really separate that out? Is it really valid to say, okay, we'll have one thing for China and then a completely different person looking at Taiwan? It's difficult, or Korea, or whatever it happens to be. So this bind we've got ourselves into in terms of index providers and an asset class called emerging markets will gradually become less relevant going forward. And the idea that you have one manager that encompasses everything within emerging market by style is also less relevant as well. So, we're very comfortable, looking at us, pairing us with people who do something else within emerging markets, because there's a big world out there. There are literally thousands of companies you can invest in. And so we can be very specific about what we do. So it's not just by country, but it's getting very bifurcated, not just for the outlook for those countries, but in terms of what you're seeing in how people invest, the strategies that they use.
What is one trend you see playing out over the next year or several years?
We've talked about quite a number of them that we've been invested in. Certainly e-commerce, but it's not just an emerging markets thing. I think one of the things that is interesting for us is to, various stages of development of the emerging markets, you can take the lessons you have learned somewhere else and apply them somewhere in emerging markets, which is perhaps less developed. When you look at things, even at a less developed level, how particular types are appropriate for particular stages of development. So, for instance, mobile money transfer is very different in a place like Kenya versus it is in China. But ultimately, we can see, okay, so China did this, and they're at this level, and China bolted on that. It's not really about mobile money. It's about the add-ons, about what else it's about lending to people. It's about extra services you can bolt on. That's where you make your money. So we look at the earlier stage in investments in less developed economies, and we can apply that playbook in those some of those economies.
All right, you ready for the speed round? Trend or fad?
Yeah.
Mass online learning, trend or fad?
Trend.
ESG, trend or fad?
Trend. Easy.
Peloton at home, trend or fad?
That's what I'm going to do after this. I would say friend.
Do you have a cool Peloton name?
I cannot disclose it. It's way too embarrassing.
How about CBD products, trend or fad?
Faddish, I think.
There's been a lot of buzz about it, and that's kind of, I can see that faddish kind of.
Yeah, when you dig through the weeds, yeah, absolutely. You can see a lot of trends or fads there, but I don't know. I think it's more, and it's just, it'll flare out in a sense.
And then finally, smart clothing and wearables, trend or fad?
Well, I like to think of myself as wearing smart clothing, but I don't think that's what I mean. Snappy dressing is not really what you're after here. I think wearables have a real future, not just in so you can see how many laps of how many steps you take a day. I mean, that's not part of it. But in terms of medical, what these devices can actually show and the early warning that they can have for imbalances that you have if you have a cardiovascular history. The earlier you know about these things, the better. I mean, and it can be crucial. Timing can be crucial in those things. So put it this way, I think they have much more of a future than the so-called dogs who have the ability to sniff out issues with diabetics. Put it that way. I think these wearables have an interesting future, and of course, it's being encouraged, let's say, because at the end of the day, it's going to provide a lot of data to someone. Data is valuable.
Well, David, thank you very much for your time. I enjoyed the conversation. How can people find you?
Are
you on Twitter? Are you?
No. I don't know. I'm glad you didn't ask about whether that was trend or fad. No, I'm not very visible, unfortunately. I'm nervous about engaging in Twitter, to be honest, because it's quite easy to get me to react to things. I know my own personality defects, which is basically inability to not react when someone says something. So Twitter is probably not for me. So it's good old fashioned. I'm at Van Eck. I run the emerging market strategy. It's not too hard to find me that way.
And we have commentary that you put out on a regular basis. People can subscribe to.
Absolutely. Yeah.
Fantastic. Great. Thank you again, David.
You're welcome. Thanks, Ed.